we've had a first run through the model and have built it out to a certain point where we found out that given this capital structure of no equity financing, we've got a 18% or so EPS accretion. So if we go down the bottom of the page, we can see that by the time we're looking at the output from my income statement, I can see that there's coming out with an earnings per share accretion of around about 18%. Now that's fantastic, and in the first year to get 18%, people will be biting your hand off. It's 100% debt financed, which is great. What's the point in putting on any equity on this? Well, there's not really a point in putting on any equity because it just works. It's going to be best, 17%, and I know that the debt financing is going to be a cheaper source. It's going to be a cheaper source of finance, so therefore there's not really much point in putting the equity on. However, we've only done one output. Well, you could say, well, the pro forma balance sheet's an output. The pro forma income statement is a balance sheet. Yes, indeed it is. But as far as the other outputs, I think this 17% is not good enough in its own right. We need some other stuff in there, which are, to a certain extent, checks. And the next I would put in is various bits of credit analysis on this, or credit ratios. The first one of which is going to be, well, it should be my debt to EBITDA. Now, I don't have a debt to EBITDA because I have a debt, certainly, but I don't have an EBITDA. So let's, for our purposes here, just say debt to EBIT, just to give an idea about what those numbers are likely to be. Now, I can see that I've got debt up there of 3,400, and I've got EBIT of 4,078. So that gives me some idea about, at the moment, it looks like I've got a multiple of 0.8 times. So I've got more EBIT than I've got debt. Now, as far as I'm concerned on that, that makes it look like bidder, not too much of a credit risk on that. It's got a whole load of profits that are covering its debt obligation. Now, if I was to then copy that formula along to Target, which we've done there, what we can see is that I'm taking on a company which has got certainly a far greater degree of leverage. And not only that, I'm actually then also financing this by way of debt as well. So I'm now taking my company, which is relatively unlevered, and I'm then adding on a whole load of new debt, and I'm bringing in a company which has got a high degree of leverage as well, which I haven't refinanced their debt. So it's that 4.5 billion is just continuing on. So therefore, if I was to now calculate what my debt to EBIT is of my combined entity, and please be aware, I should be talking about debt to EBITDA or net debt to EBITDA, but given the limitations of the numbers here, I've therefore got 2.9. Will this company, bidder, will it get re-rated? Yes. That is an enormous move in its credit ratio, or one particular credit ratio, and if we could do others and we'd find the same result comes out. It's going to be an enormously more risky profile that this business has got, and so consequently I don't think we really can get away with this being 100% debt financed. I think we're going to have to do a mix. No one is going to lend us, certainly at those terms of 6%, no one's going to lend us that amount of money. So therefore, let's try and build the flex into the model. Now, just as a check on that, I'm now going to put into this, a new amount of equity. And just because I want to know whether I'm going in the right direction. I'm aware that my debt to EBITDA, or my debt to EBIT, as we've got it here, is 2.9. What will it be if I put more equity into this? Well, that number should go down. If it doesn't, I've done something wrong. Similarly, my EPS accretion. I am aware that debt is cheaper than equity, and it is for this business. So therefore, that 17% EPS accretion, that should go down. So therefore, the 17% should go down. The 2.9 should go down. I should also have a balancing balance sheet, so row 46. So there's another check that I've got in place. I still should have a balancing balance sheet, and my sources should still equal my uses of funds when I put this through. So consequently, I've got a whole load of checks which are built into this model. And I'm just using my financial knowledge to try and work out, well, what should happen? And that's a good place to be. I've now got a structure. I can then amend my model within the confines of that structure. So let's change this, equity financing proportion. Well, let's say it's 100%. Let's go for 100% equity financed. Now what happens there, it looks like if I've done that, then it looks like my new equity raise has now been the whole 8564 and my new debt raise has now gone down to 0. Well, my new debt raise will have gone down because it's really the plug. The new debt raised in line 16, if I just go, line 17, I apologise, if I go to that and I just say, well, where does that come from? It's really the plug that says, I need 8564, where is it coming from? It's coming from the other sources, and then anything that I haven't raised from those other sources is then going to come from debt. Okay, so my sources and uses balances. Let's go further down. My balance sheet should balance. So first thing is sources and uses done. Second thing, make sure your balance sheet balances. Well, it doesn't balance. I can see it's not balancing. I can see that my adjustments aren't balancing in the bidder company. So what was the process I went through? Is first thing is account for the sources and uses of funds. Well, I've accounted for my uses, 8564, but I haven't dealt with the sources clearly because my debt, that's all right. That's come from my sources of, my uses of funds. But if I then go back up to my sources of funds, I can see that it's only my new debt raise that I've gone and shoved in there. What about this new other figure, this new equity raise? Well, this new equity raised, that should be going into my balance sheet as new equity. So therefore, let's shove it down there. So new equity, now is it common stock? It's common stock and additional paid in capital. Really, it's two of those together. Let's just put it down as one of those figures for the purposes of this. So we've got new equity raised. It should be split between common stock and additional paid in capital, but for our purposes here, it's just really the equity. So we'll shove that in there, and that now means my balance sheet balances, which is great. My goodwill, just to make sure that my goodwill arising, it's still costing me 8564, and I haven't made any amendments to target company, so therefore that seems reasonable. Yeah, so I'm happy. My balance sheet is balancing, and it's balancing for good reasons. So I've now got sources balancing, I've got my balance sheet balancing, and then I need to have other things. My debt to EBITDA, has it gone down? It was 2.9, it's now gone down to 1.8. That's a good thing. So therefore, that 1.4 figure for debt to EBIT, I'm happy that that has gone down. However, my final one is EPS accretion dilution, 30.85. I don't think so. So what's happened is that we've now issued something that is more expensive called equity. And that is more expensive than debt, and yet my results have improved. Can't be the case. So let's have a look. If I'm looking at my adjustments on there, if I go down column F, I can see that my debt, I've gone and put the accounting results of if I've issued no debt, there's no new interest. I've then also got another adjustment that's gone through the balance sheet, which is to do with additional paid in capital or new shares. Well, what's the effect on the income statement? Well, there is no effect on the income statement, but there is going to be an effect on my number of shares. And what is going to be the new number of shares that are issued? Right. Well, there's going to be 8564 is going to be the total resources that or value of those shares. So that's 8564 is the total funds that are being raised by way of new equity. But I want to know how many new shares that is. Well, it depends on the share price. Which share price is relevant? Well, let's have a look at the share prices which are possibilities, which are at the top of the page. Is it the share price of tuna? Is it the share price of pasta? Well, what shares are being issued? It's shares in tuna are being issued, so it should be at 23.45. But should it be at 23.45? What about pasta's shareholders? Will they want it at 23.45? They will want that price to be at a lower value. It'll be at $20. There's going to be imperfections in the market, or the market doesn't like this, and therefore they think there is uncertainty. If there's uncertainty, tuna's share price will go down at that stage, would be the argument from the sell side, from pasta. So therefore, maybe 23.45 isn't the right price. However, Tuna's advisors would say this is a fantastic deal. It's a fantastic deal for everybody. The market may not understand it straight away, but we'll try and get that message over well. And if they do understand it, then undoubtedly what will happen is once they see that everybody is better off, there is enormous accretion in this deal, then the share price will go up. And therefore 23.45 is not a good price. It should be a figure that is 25. So therefore, there's a bit of a discussion and negotiation about, well, what is the appropriate price? I think that credibly, the only one we can really go for is therefore this 23.45 as our starting point. That's what the market price is at the moment. And so therefore taking that as the price, then we can work out what the number of new shares are that are being issued. And there's 365 million of those new shares are being issued. So therefore, after this transaction, there is then 2365 of shares in issue. If that is the case, that will then, I've got an extra 365 million shares are in issue, added to my 2 billion, which then is set against my new net income of 3164, and therefore my earnings per share has still gone up, but it hasn't gone up by the 18% that I was looking at previously. It's only gone up by the 10%. And that makes sense. It should be less attractive looking at it from an earnings perspective. And then now I know that this is working. If I was to change, if I was to flex that offer structure to be, or the capital structure to be a mix of debt and equity, so change that to anything that I think is appropriate. What I could then do is I could then sensitize this and try and get it, well, what is the optimum capital structure for this that would give us the level of EPS accretion, the maximum EPS accretion, but whilst also being financeable from my leverage ratios perspective. And we've got that structure set up. What we now need to do is maybe add some more stuff, and then we'll be able to flex the structure once we've then added on all the bells and whistles to come up with, well, what should this transaction be done at?